Welcome, everyone, to today's podcast, I was about to say, but today's roundtable conversation. We're doing it live for all of you here. And we're going to talk all about how to be successful as a fund manager fundraising from the US. And we'll also have a little bit about investing over there and bringing your portfolio companies to the States. That is, of course, a topic that's important to all of us, one we should dive much more into. But we have David Rose, who's a very experienced operator and one of the best in this. So for that reason, we will divulge a little bit into that topic as well. But before we get into the topic of managing LP relations and fundraising in the States, let me just run around the horn here and get an introduction from everyone. Matias, maybe will you be the first one to go?
Yeah, sure. Thank you, Andreas, and great to be joining here today. I'm the CEO of ACE Alternatives. We are a dedicated fund administration operations service provider to the alternative asset industry, working in Germany and Europe, extensively going into other countries, working mostly with VC, but not only, but also PE, fund of funds, etc. So our domain expertise is around fund operations as well as accounting and tax. Felix will mention a few words in a sec. What makes us different is we are long-known operators with very deep experience, and as well we are tech-driven. We develop tech to make service-oriented operations, let's say, best possible and best practice as you can find.
Beautiful, Matias. Thank you. Let's go directly to you, Felix, as part of the team at ACE.
Hey, everyone. Good to be here today. My name is Felix. I'm the co-CEO of ACE Alternatives, and at the same time, I'm heading the ACE tax team. Previously, I've been working for 23 years at PwC as a senior partner. I've built the private equity fund practice in Germany, and now we are trying things differently and building more technology and help our clients to provide service via one source of truth.
Beautiful. Exciting. And then David Rose, in the end, tell us a bit about yourself.
Thanks, Andreas. Yeah, as you mentioned, I'm a longtime operator here in the U.S. So I'm David Rose. I'm the CEO at U.S. Expansion Partners. And just by background, I've done 5 venture-backed tech startups and a 3-time CEO. And now I lead U.S. Expansion Partners, which helps European venture-backed tech companies launch and scale their operations in the U.S. market.
Thank you, David. Okay, but then let me just, set the context, at least how I view it, and maybe the rest of you can pitch in on this. So when I think about this topic, and the reason I thought this was an engaging conversation to have with you guys was, honestly, any firm that gets past Fund 1 will start to be thinking about raising from the States, even if you don't really do much there otherwise and don't necessarily have an established network already. You know that money from the States is definitely going to be in the mix once you get to Fund 3 and Fund 4. So starting to warm up those connections is just important. However, there's quite a few that reach out to me and ask, what do you think, Andreas? First of all, how do they think about Europe? Secondly, are there any important do's and don'ts? And what should I expect? Are there anything that's different? Or what about the rules when it comes to engaging the LPs and doing the roadshow over there? So for that reason, of course, the 3 of you have experience across these. You're not fund managers yourselves right now. You have been before, Matias, so you know a bunch. But you also see this, of course, with all your clients. So Matias, maybe you'll because you brought the topic to me and said, Andreas, should we do something on this? And I said, absolutely. So why did you think this was so important, Matias?
Yeah, thank you, Andreas. So as you mentioned, I think with most of the growing GPs who enter fund generation 2, 3, or further, looking into US-based investor base makes increasingly sense. Why is that? Obviously, because US asset managers or allocators have more experience, let's say, with VC and private equity programs and do allocate more proportionately to the alternative asset sector. Hence, I think it's a highly attractive investor base that would be just natural for European fund managers to tap into. We have seen that, or I've seen that, also in my previous career as a fund operating partner. We used to have pretty extensive US LP base, but it comes also with, as you said, the kind of rat tail around red tape So one needs to be aware of that. But, once you get into US LPs, I think it's a very, very good and steady stream of substantial cash amounts and investments that you can create from the US. So I think it is good to have such an investor base, because you need to actually broaden your investor base outside of Europe, because Europe is still, if you look at the proportionate allocation to alternative assets, it's most certainly still lesser than what you see in the US and probably even Asia. Hence, we think it's important for any GP to build up those relationships. And as we all know, it's a relationship build game. It doesn't build overnight. So you may have to build up and maintain those relationships over one or even two fund generations, show your performance, show your stability, reliance, and then you might attract some very significant US tickets into your next fund.
Yeah, absolutely.
Maybe to add to that, if you look at the big guys in the European market, the EQTs, Permiras, and so forth, they all have a pretty huge US investor base. So if you're a small fund manager and you want to grow and you want to develop, there's, as Matias said, a point in time where you need to step into that market and attract the US money. And I think for the US investors, it is also interesting to tap into the European fund market and target market, because we have attractive targets in Europe, which are still undervalued compared to the assets in the US market. So I think it's of mutual benefit to build relationships.
Yeah, and actually now I want to go to you, David, and ask you a question that's a bit different, because you're sitting in the States and you know what your peers are saying about Europe. So I'd love to ask you, what, just as an intro to this whole topic, what is the current state of affairs when you are meeting your colleagues and talking about Europe and the opportunity that we call Europe?
Yeah, well, Andres, part of our thesis is and I have the operator's lens on this, right? I'm not an LP, but part of our view on this is if a startup is raising professional venture capital around or beyond, the only reason they're able to do that is because they've convinced their investors they have a shot at being a billion-dollar segment-defining market leader. And, that's the full stop. No one else gets funded. And I think the reality of it is, if a company is going to take a legit swing at being a billion-dollar market-defining leader in their space, they're going to have to come after U.S. market share at some point. And so I think there's obviously a lot of differences in the markets from an operational standpoint and go-to-market. But I think that there is generally here in the U.S., what you'll find is companies, whether it be general partners coming to raise funds or startups coming to the U.S., you're generally welcome with open arms. I mean, people are always looking for an edge in the U.S., and whether that be an investment edge or an edge working with a startup. So I think that the general sentiment here in the U.S. for European investors and startups is quite bullish.
Is that your experience as well, Matias?
Yes, I totally concur with what David's been saying. So I think for any ambitious unicorn or a similar type of startup who even wants aspire to becoming a decacorn, there is no other way than tapping into a U.S. market. First of all, for market growth, and secondly, as we all know, looking at different exit routes, you would obviously want to consider U.S. tech companies as possible suitors to buying you if you are not basically pursuing an IPO track. And then vice versa. We know that Europe has a very strong technology base, hence having, let's say, programmatic investment pool programs here managed by European fund manager makes an awful lot of sense. Hence, supporting European-based VCs and investing in such, let's say, promising European tech startups is again something that we see that US investors are doing. And I would actually say, if we look at, let's say, the current political environment. So if we look at, how the public capital markets have developed, there has been, a lot of concerns about stability. So investors have started to diversify their portfolios, looking more into international markets. Obviously, as we all know, alternative asset markets don't move as fast as liquid markets do. But what we're seeing is investors are increasingly looking into, let's say, non-US investment programs, hence dependent on obviously how long this, let's say, current implications from the US administration is going to prevail, there might be, let's say, an increasing shift into international assets.
Yeah. And then there are those that think that right now it's the time for the US to double down on the US. So in that sense, I think that you definitely have to also remember that there are those that exhibit the behavior you just described, Matias, but there are also those that are on the MAGA movement and for that reason are reshoring their own money as well and doubling down behind their own economy. And we're seeing the same thing in Europe, which is for us, of course, equally good and great. Felix, you are the master of a lot of regulatory and tax stuff, and that is part of the whole devil's knot that you need to figure out how to manage when you're going to the US. So I want to ask you, first and foremost, going to the US to fundraise, if I ask you the big question, how difficult is it? What should you be thinking about? What pops into your mind?
Yeah, I mean, the US investors obviously expect what they are used to, and the US investors are typically used to US structures and US alternative investment funds. And those are typically established in form of limited partnerships, often in Delaware, and with LLCs as holding companies underneath. And this is used to, first of all, ensure tax transparent treatment at fund level, but also to allow the fund manager to treat the underlying holding companies, i.e. the US LLCs, as transparent entities, as flow-through entities. And the whole purpose of that is to preserve capital gains taxation for the investors. So capital gains taxation is important for US investors because capital gains are taxed at beneficial tax rates. And therefore, if you want to place your European funds to US investors, you better make also sure that you hit all these boxes, i.e. make sure that your fund is transparent, make sure that there's no additional layer of taxes, and ensure that you can preserve capital gains treatment for the US investors.
Could you unpack this a little bit? If you are, most European funds will have a European-based fund. And what does that mean when they're then thinking about bringing US investors in? I think you can kind of say there's maybe 3 stages that's worthwhile discussing now. There's the ones that are thinking of just bringing, I have 4 small time angels, but they've been really valuable. I really like them. I'd love to get them in. In that scenario, what should you be thinking about? And then when you're starting to have some of the larger players, what should you think of then? And then the full-fledged model where you're raising significant capital in the States, maybe we're talking upwards of 30-40% of the fund. What would you then advise? If we're thinking of these 3 scenarios, what are the structural implications for you as a fund?
Yeah, I mean, if you just have a few angel investments, you obviously also want to make sure that they are happy and that you meet most of the obligations, and also make sure that they get capital gains treatment. And to ensure that, you first of all need to make sure that your own fund is viewed as tax transparent under your local law as well as under US law. And for that, if you use, for instance, Luxembourg SCS or SCSP, that would principally be tax transparent. You could file a protective check the box selection to ensure that it's also tax transparent under US rules. And thereby you look through the fund, and that's what they typically expect.
And you don't need to set up tax blockers and extra entities to be
No,
able to.
in principle not. I mean, in particular, if you are a VC fund and are still investing directly from the fund into the target assets, then you only need to make sure that the fund itself is transparent and that there is no additional layer of tax.
Which you're already doing for your European LPs.
Which you already do for your European LPs.
Is there any guidance to the US investors that you need to make that would be wise and say, because sometimes you have people that do investments here for the first time and they're like, I'd love to back you, but what are the implications?
I mean, you need to make sure that it's transparent. You can tell them, okay, this is a SCS or an SCSP. This entity is principally treated similar to a Delaware LP, so you should generally be fine. But to be 100% sure, let's file a protective check the box selection to treat the fund as a flow-through entity, irrespective of certain legal features which could undermine the flow-through status.
Andreas, and maybe just chiming in on that, in addition to what Felix said, obviously for US LPs, you would very often also provide, let's say, separate tax disclosure, which would come, out of the feathers of a professional like Felix, where you would say, okay, this is the tax status in Europe. As we said, it's a tax transparent vehicle. Any implications for US would be treated in a certain way, dependent on how you qualify as a US investor. This is obviously something that gets then more complex. So where you would have to probably engage, let's say, not only with your local tax advisors and experts, but then also with US, which may then obviously imply, let's say, that the ticket price or the cost for putting these structures in place is increasing, sometimes even quite dramatically.
When do you see this making sense typically, Matias? Would you say that it's already, so if it's two guys that you really love and they're coming with 200K, you should do it? Or are you saying, as a general rule, unless you're talking a couple of million, it's not worth taking in US investors?
Well, I mean, it's very difficult to say, because I think, first of all, as Felix mentioned earlier, if you have, high profile angels who are very supportive to your deal funnel, making intros to, let's say, US peers, on the tech side, then I think it makes sense to engage with those people separately. But there are always different ways how you can bring those people in. So you might not necessarily have to consider them even as regular LPs, but they can be part of, let's say, probably even the team vehicles. Brings different other complexities with it, but that can be considered. I think, in a general, there has been some ballpark estimates that if you need to put separate documentation in place, or even consider putting a separate US vehicle in place, as Felix mentioned earlier, anything below, let's say, a good, let's say, 7-digit number, doesn't justify, approaching US as a market, because the cost is simply just too high. And if you need to consider putting a US based vehicle, let's say a parallel fund or a feeder or something like that in place, then the ballpark numbers have been somewhere in the ballpark, let's say 5 to 10 million US dollars as a minimum. And I'm really talking about minimums here. Then it again depends very much on, what kind of advisors you're engaging with in the US. So if you go, to bulge brackets, US and New York based law firms, their prices are obviously very different than when you go to some, great experts, for instance, in the Atlanta area.
Any commentary on this, Felix, from your side?
No, I think that covers most of it. And I think just to add, once your fund grows and you have also holding companies established, and obviously you may also want to consider filing check-the-box elections for US purposes as well, to make sure, again, that they get flow-through status and can get capital gains treatment. So I think that is still the most important thing that US investors want to see. To add to that, the investors want also to make sure that you file on time. The filing deadlines in the US are tighter than in Europe. So typically the US investors need to file with the IRS in April, May. So to meet that, you need to be prepared, need to have all the numbers. And the US is typically first to be provided with tax numbers. And if you are a small fund that only has a few angel investors, you are probably not the tax expert, the US tax expert yourself. And therefore, you either provide the angel investor with raw data, which he can then incorporate into his own numbers. That is probably the prevailing view. However, if your fund grows, if you have 40, 50% US investors, then you obviously need to have a US tax expert on board to also ensure that the US tax filings are done properly. You get the 1065 form out in the right way, filed US Schedule K1s for each individual US investor. So if you grow your US investor base, you need to adhere also more. And
How much?
Andreas, and if I may add on top of that, because this is a very important point that Felix mentioned. So early tax filings by US investors around April, which is, let's say, the default, filing date, means or implies for the European fund manager that they need to have closed their annual accounts already by Q1. And we know that's a super stretch, especially if you consider that many of these funds are subject to, statutory audit. So you have to do a very fast closing of your accounts, do an audit, have, let's say, confirmed numbers, and then you, let's say, are able to provide investors with the relevant, tax filing data. So this means that anybody who's doing this needs to have, super efficient processes in place to basically then confirm to the US investors that you can provide them the tax numbers by April. This means that either you have great service providers who are helping you with this, or you are capable of doing this in-house. But whatever it is, it remains a challenge.
How much of this falls on the fund manager and
Mm.
how much of it falls on the LP? So is it fair, so to say, that once you take US investors on board, you take on the responsibility of making sure you service them by these deadlines?
Well, yes, you would take that on board, actually, because you are under fiduciary duty to provide to the investors the data they need for their own specific tax filings. Obviously, everybody understands the fund is, let's take the example of a German fund. So German funds operate under a certain regime, and the statutory filing dates, as Felix mentioned earlier, would be very different in Germany. Now, once you take on board US LPs, they would actually want to foresee that in the documentation there are special provisions and undertakings whereby the fund manager confirms that he is able to do earlier, let's say, tax number presentation for the US purposes. So yes, it would actually come with such handcuffs normally. So either you have a specific provision already in the LPA, and if it's not in the LPA, then you would probably include that as a separate provision in the site letters. Yes.
I'd love to ask you also, because this is a question I often get, what should you as a European fund manager be thinking about before you go and fundraise in the States? And here I'm, of course, thinking about the situation that you don't end up with breaking solicitation rules.
Very good point. Yeah. So I think that regard, Andreas, as you said, placing a fund with investors in any given market, around the globe will kind of always trigger the thinking around what are the regulations that apply. So how can you basically market your product, because it's a financial product, to investors in any jurisdiction. And this, especially in the US, where we know sanctions can be very severe, you want to have a very close look into this and have, good counsel supporting you in this process. Because again, if you get this wrong, there will be severe sanctions. So the worst thing that can happen to you is you hop off a plane in LA or New York and there's somebody waiting for you and saying, hey, we just saw, recent activity from you guys. You didn't file with the SEC, so let's talk. So nobody wants to go there. So this would obviously mean that you would then have to investigate for yourself. Are you under certain filing and registration obligations with the SEC or with local authorities? Because there is, let's say, state provisions as well as federal provisions which would apply to this. And if under certain, or are you under certain exemptions eligible to fundraising without separate filings? And, this is where, for many of these alternative asset vehicles, which are located, outside the US, you would have, these placement exemptions that would apply, under Companies Act and securities laws. And this is something that you want to obviously consider very, very early on, because otherwise you cannot approach the US LPs, because any US LP will also ask you for disclosures on, what exemptions or what placement rules would apply.
Are you guys able to, here on this podcast roundtable conversation, to go directly into what SEC registrations and exemptions European fund managers need to comply with? Or would you say there's not much reasoning going in too much detail on a call like this, because you really need to get hands-on evaluation from a team?
Yeah, I think, there are some general guidelines that would obviously apply where you take basically reference to, certain provisions in the Investment Company Act or similar, and where, there are a few, like Section 3C, where you have certain exemptions to, the registration obligations that would apply on, let's say, the type of placement that you are doing. So to how many investors are you placing, or the qualification of investors that you are doing with. So, little bit similar to what we see here in Europe, where, kind of institutional investors, there you have, let's say, lesser protection needs. So accredited investors, there you wouldn't have to do any registrations. But then again, dependent on, how many investors you want to approach overall, you would have to look into different, let's say, exemption options. So Section 3C, there is number one, if you raise with less than 100 investors, then you can apply that, and then you can raise mostly from so-called accredited investors. These are, let's say, highly qualified, professional, sophisticated investors. Then you can basically use that exemption. And then when you do, let's say, the information or the notification to the SEC later on, because you have to do that, then it would say, look, we had less than 100 investors, and most of them have been so-called accredited, and so we're good to go. So that could work. But then again, you need to have a very, very clear documentation on who have been qualified as accredited investors and not. And if we talk about, the ramification, if you get that wrong, I mean, that can be terrible, because then your entire placement might be requalified as a, let's say, public placement, right? And that is terrible. You can't go there. That comes with severe ramifications.
Just to clarify 100% clearly, Matias, are you saying 100 investors involved in the process, or
to whom you are basically placing the fund? Exactly. 100 would be a limit.
So you have 100 targets, so to say, 100 shots on goal.
You would have 100 investors who are subscribing to the fund. Correct. So it's at the end of the day, the question is who is subscribing. So if it's 100, so you don't know before who is subscribing. But if you have 100 investors,
is that 100 US investors or 100 in total?
Actually, the interesting piece here is 100 in total. Right. Yeah. So you would have to be very careful here. So understanding, and then, it comes back to your earlier question. So when does this make sense in the US? So how much are you able to place in the US, right? Then, to make all this effort in terms of documentation and process, because this is additional documentation and process you need to do for the US, you would obviously want to, let's say, raise already in quite a substantial amount from the US. Yeah. And the other exception is C number 7, where you are only placing with qualified investors. There you have no limitations in terms of number of investors, but these are, if we're talking about qualified purchases, these are pension funds, let's say large wealth managers, etc. only. So obviously this is more something that you use as structure when you are for the bigger funds, so growth equity, private equity, etc. Whilst let's say the section 3C number 1 is more, for smaller VCs and PEs.
How about AML and KYC? So that's a bit of a different beast in the US. So let's just touch on that one a little bit.
Sure. I mean, if we look at AML and KYC, and we're coming from the angle of a European fund manager, then again, same rules would apply. And let's take a German fund manager, for example. German fund manager would be subject to, German anti-money laundering regulation. So he would have to basically, when he's onboarding any investor from, around the globe, he would have to apply the same rules. So this would obviously then apply to any US investor who would be onboarded. So he would basically, come through the same rules, which is you have to understand who is, let's say, the investing entity. You would need to have all the registration files. You need to understand who is the beneficial owner behind that. And that then brings all the rat tails. So how do you basically ensure, for instance, for beneficial owners, what's their, registered address, etc. We all know that US have a very different system to ensuring that where do people have their official address, if any, similar situation as you have in the UK. So you would probably have to do, let's say, more work, and even then ensure that even, you have confirmations from local US counsel on certain documentation related to LPs. So again, there probably a higher documentation need, in individual instances.
Yeah. Felix, do you have anything to add so far? And same to you, David?
No.
Then, Felix, let me go to a big question to you, which is the tax and structuring considerations when you go to the US, especially when we're talking endowments and pension funds. Are there anything here that you really want to think about? I'd love to understand better the feeder funds and the blockers and the parallel funds. When is what relevant? And what should you expect to hear from U.S. investors?
Yeah, I mean, in particular, U.S. tax-exempt investors don't like so-called UBTI income. That is kind of trading income. That is something that would raise and trigger taxes in the U.S. for these, in principle, tax-exempt operations. And therefore, you want to make sure that your fund doesn't create any UBTI income. And in terms of the structures, I mean, as long as the structure is transparent, I think you can use any structure. But for endowments, the question arises whether you want to interpose a vehicle, a blocker, to make sure that they don't get allocated any potential UBTI. So often you see in the US structures, in particular, if they have a global operating fund, you often have the Delaware fund and in parallel the Cayman fund. And the Cayman fund is primarily established for endowments and for other tax-exempt US investors, as well as for European investors. And therefore, if you establish a European fund, you want to make sure that they also have the opportunity to invest via a blocker company.
At what stage do you typically see parallel funds being set up? What fund sizes are we talking about here? What number of LPs? What profile of LPs?
I mean, the big guys are doing that. But I mean, if we talk about parallel funds,
because we see, let me rephrase, because we see quite a bit in Europe, right? It's not that unusual to see U.S. funds that are also active here set up Luxembourg and so on funds here.
Yeah.
Because European investors can be quite demanding on that side and saying, well, we're only doing it if I can put it in a European domicile fund.
That's right.
Only the big guys are doing that. Obviously,
I've seen it with multiple 150.
Yeah,
That's
really a cost-benefit analysis.
Yeah, but Andreas, I agree with you. I mean, we have seen these parallel funds. I would say ballpark is somewhere around 100. I would say that's a pretty good demarcation line. So 100 million, let's say euro VC funds, that's where it starts to make sense. So parallel fund structures, be it in the US for a European fund manager or, vice versa for US fund managers. I mean, touching on the point, why would a US fund manager put a parallel structure in place in Europe? Obviously, as Felix just said, European investors would want to basically invest through a European vehicle. So exactly the same kind of mirror image we see in the US. But then again, it has a lot to do with placement regulation. So under AIFMD, you have certain rules where if you were purely operating a US regime fund, placement here in Europe would be prohibitively difficult. So that's why, similar to what we were talking about, on the US soil, you would then be enticed to setting up a separate structure. Yes.
But it's really more a regulatory topic.
Exactly.
A tax topic, because from a tax perspective, it doesn't really make much of a difference.
Yeah, and to the GP, it's a fundraising topic. Let me ask you guys. Then there's another thing. Now we're all talking tariffs, but here it's not called tariffs. Here it's the tax treaties between our individual countries. Could you tell me a bit about where should you be mindful when you're talking to U.S. investors?
Yeah, I mean, you want to make sure that the structure is treated the same from both jurisdictions, i.e. if a structure is transparent from a US perspective.
Yeah. And do we have, and my question is then, are there any jurisdictions in Europe that are significantly disadvantaged when it comes to bringing on US investors and not having these issues?
No, I mean,
they're all the same.
No huge disadvantage whether you have your fund in Luxembourg or whether you have it in Germany.
I'm sure in 6 months it's going to be super expensive if you're a Danish fund because Mr. Trump wants Greenland. So maybe just touch on 1 second why the US LPs prefer Delaware structures rather than European fund structures, and maybe say a bit of the differences here.
Yeah, I mean, that's what they know from the US. That's where all the US investors invest directly into the US.
How does a fund manager best approach this topic or kind of quell the anxiousness around a European structure? Is there anything that
They can obviously they compare the LPAs and demonstrate that Luxembourg SCS is not that much different from a Delaware LP.
So I spoke to a European LP, and he described his conversation with the European fund manager, and he said, so I come to him with my side letter, and then the fund manager says, yeah, that looks good, but I would like us to be using my side letter. And then he comes back with his side letter, which is then, as the European LP described it, in complete US legalese. And he was quite frustrated with that. In the end, what this European LP said, it might have actually in the end had more or less the same language or the same core points, but I would have to bring it to my legal party to then read everything through and so on and so forth. Should a European fund manager expect the similar situation, but just in the reverse? In the US, that if you bring European documentation to the States, you should expect many of them being a bit frustrated with the lack of US legalese. Yeah. Matias, you look like someone about to comment.
Yeah, I think there.
Sure. I mean, if everyone has its own standard legal doc and they exchange the standard legal docs, and then negotiations take place to make it fit for everyone. But in general, my experience is that the fund is the one who should provide its legal documentation and not so much the LP, because at the end of the day, the fund needs to manage all the different side letters. And if there's no consistency between the side letters of different investors, then it's a huge pain point over the lifetime of the fund. So there's also some benefit to really take the side letter of the fund as a basis and then negotiate here and there the terms that you yourself would require as a European investor.
Does that mean that you would recommend a European LP rather than bring their side letter to the fund? You'd recommend that they bring their demands, so to say, and then the fund manager is able to build the side letter on the back of their core legal docs, but let it reflect the wish list from the LP.
I think that would be probably the most efficient way of addressing this. And, let me just add another additional perspective to this. Side letters are extensive. If you look at, let's say, the overall bill that you have to vote for putting a fund structure in place or to bring your fund to a closing, a large part of where the legal counsel work gets expensive is extensive side letter negotiations between the parties. And I think it's no surprise, the more international and the complex the structures get, the more negotiation there is around the side letters, also with the more sophistication there is on the LP side. So there is one aspect actually how you can mitigate many of this. First of all, as Felix said, harmonization of documentation. So already knowing what are the expectations of your prospective LP base in that regard. And, one great effort to minimize, let's say, that requirement is you harmonize your LPA, so your limited partnership agreement, around the ILPA standards. So ILPA has put a great effort into, putting, let's say, best in breed practices into the LPA standard so that you can actually minimize the needs that you have then for side letter negotiations. When it comes to tax, everybody else thinks things are more difficult. So in that regard, you would have to address that separately with each an LP, because they may have different needs or even different in-house policies. So you don't get around that, categorically, but you can reduce a lot of that. So I think the best is most certainly provide your own standards. Try to follow as much ILPA, coordinate that with your fund counsel, with your, let's say, US correspondence counsel as well. And then it should be good to go with hopefully very few iterations.
Yeah. Now, we've spoken a bunch about structure, a bunch about tax, a bunch of the boring stuff. I do think the boring stuff is why people love EUVC, because there's not a lot that bother doing a 1-hour conversation about structuring and taxes and stuff like that. I do think that is time well spent. But I should think we should end this roundtable on talking a bit about the fundraising process and the practical challenges. And David, I want to call you in here because you're US based, you're US heritage, you understand the US market so well. You've brought so many European teams to the US, European startups to the US. So I'd love to ask you about the US mentality when it comes to fundraising, and what's the most important thing for European GPs that are coming to the States to really understand that this is where a US LP, a US investor, will expect things to be a little bit different.
Yeah, Andreas, there's a lot of operational details that are different, and there's certainly some cultural things that are different. I think a lot of times my friends in Europe who speak English watch the same TV shows, kind of think it's the same culture, and there's some significant differences. And I think one of the big ones when you're thinking about what an LP is going to expect in the U.S. or when you're competing essentially against raising from U.S. GPs is there's a little bit of a difference in expectation of the end game. Where I think in Europe, if you have someone who has an operator who has a 3x exit, I think that's a pretty happy day. In the U.S., if it's not a 10x, they'd rather just shut it down. So there's pretty much a different mental approach to all or nothing, winner take all versus incremental wins, and that's a pretty dramatic difference. And I would say that on the operator side is I would give you two examples. The first one is I would think that the first thought that a CFO at a U.S. venture-backed tech company has with their first cup of coffee in the morning is, how are we going to increase enterprise value today? But I would tell you, probably their counterparts in Europe, the CFO at a European venture-backed tech company, I'm pretty sure their first thought with their first cup of coffee in the morning is, how are we going to preserve capital today? And it's a pretty different approach to business altogether. So there are some pretty big differences on the mindset and approach to business in the U.S. versus the Europeans. And so just be aware of that. If you're talking to U.S. GPs, how they're thinking about returns, how they're thinking about portfolio companies and expectations are going to be pretty different.
Yeah. Matias, you're smiling a bit, so I'll bring you up here as well.
No, I totally agree with what David was saying. If we look at that again, from a European GP perspective, I mean, if they're pitching, I'll deliver, let's say, 3x net return, fund on, cash on cash for the fund. Obviously, many LPs who are, used to working with US GPs would say, look, it's not attractive. So why would we actually even bother? So I think there is more, dynamics, more ambition in the US market to create value faster. So less time to lose. I think that's something where we can most certainly learn as a Europeans how the US ambitious US operators are able to create faster value, and even if they see that it's not going the way it should, then basically cut your time and capture your attention and then refocus on the more promising assets in your portfolio. But then again, as David said,
can I ask you, because this is a constant discussion, and you some say what you say, and some are vehemently against it and think that it's a narrative that's not serving Europe at all and it's not correct and so on. And I'm probably a bit in the middle, where I'm saying, well, there's definitely a very clear distinction in how we talk and the narrative that we put. So as an example, European that looks at data that says that a typical venture fund brings 3x will say, well, my target is 3x. That's what I'll communicate to you as an LP. I'll communicate 3x to you, and then say, of course, I'm going for 10x. But I'll not give you a portfolio model that assumes that I will be hitting a decacorn, and then avoid over-promising, so to say, and just say, well, there's no reason to spend a lot of time talking about the make-believes. Whereas the U.S. investors tend to be, a bit larger than life in their communication. And same thing when we then talk about our portfolio. But in reality, I don't know whether our management of the funds are that different. I think we have more funds in the U.S. that are spray and pray, large spray and pray is the derogatory term to describe a large
portfolio.
Diversified portfolio. And I don't mean it as such, because I actually like those portfolios a lot. That is how if you run that type of strategy, you will be quicker to say, I'm going to focus just on the winners. I'm going to focus on the next investment. I'm not going to do a bunch of work with all these things in the middle.
Sure.
And you have more of those funds than we do in Europe. So for that reason, we also tend to have more fund managers in Europe that talk more about making sure that you at least make 3x on the existing, or 2x, or at least 1x on the portfolio, parts of the portfolio that are struggling. And then it all comes back also to the fact that US outlier companies are just larger outliers. So for that reason, you can be a better okay with the power law. You can write a bigger power law. So all of these kind of make me think that the operating model is not necessarily that different. A lot is in the narrative. And then there are more of the US funds that have a profile of a portfolio model where they are just by definition playing by the power law 100%.
Yeah.
Whereas in Europe, we have more with concentrated portfolio.
Yeah, look, Andreas, I totally agree. And, I have a great sympathy for, the more extensive portfolio models as well. I mean, it's pure mathematics. So, there is this one guy whom I really admire for his portfolio model, and that's Clint Corver of Yulu Ventures, who has, been pioneering on this, and he's doing a great job. And because math will show you need, let's say, 40 plus assets in your portfolio to be able to, have a high probability on a home run. And home run being, let's say, investing in a unicorn. Anything below that, you could simply go into a casino and flip a coin. But then again, the other side of that is however you invest into a portfolio company, then you need to make sure that those portfolio companies can operate in the US. And that's basically where, our thinking with what David is doing on his side resonates so well, because, what we consider on the fund structuring side, so how do we avoid the pitfalls? David's company basically avoids those pitfalls for the operators, right? So I think that's worthwhile always considering, because, you may have the best value proposition in the marketplace, but if you, pardon my French, screw up badly with how you structure your US operations, then you're basically, leaving money on the table. Right. So I think more sophistication and good work ahead goes a long way.
I want to go to one important question that I really need to make sure that we make it to. So I'll try and ask my questions short. I'm not good at that. But I want to ask you about fundraising timelines and communication styles. Because it's a common understanding that American LPs prefer more concise, data-driven presentations, whereas in Europe, we have more LPs that are a bit more relationship driven. Can you talk a bit to whether there's truth in that and what that implies then for the fundraising GP? And of course, fundraising timelines becomes then the product of the communication style.
Sure. I think, what you can see as a pattern is, yes, US LPs want to, if they do a placement or an allocation with a European GP, it's a much more driven process, more focused, so they can do the allocation and the review much faster. Oftentimes they do engage through, let's say, separate external advisors as well, who understand the market better. So that may be another aspect that you may have to, let's say, basically also consider. So if you're talking about, pension fund allocators, etc., they often go through intermediaries. So you will have to consider that. That means your approach to the US LP may be not direct, but indirect through, let's say, a separate advisor, which means building up early relationship, giving benchmark numbers, talking about fund documentation, and then get, let's say, faster into the allocation decision process could be basically probably the winning formula. So from what we see, the US investors are in large, they are more professional and sophisticated when it comes to the process. Why is that? They have to be, right? Because their allocation decisions are so extensive, right? Because they invest so broadly into alternative assets. So they have to be professional. Otherwise, they go under. In terms of processes, it can be anything from 3 months to 18 months, even if you have an established relationship. So it's very difficult to give you, a specific number here. But again, no US LP, unless you are very fortunate, will invest, once you approach them first time. So they tend to establish long-term relationships and only, have the expectation that you might not place with them this fund, but maybe the next or the one after. So it's a long game.
David, I'll let you take the final remark here before we close. Do you agree with what Matias just said?
Well, sure. I mean, there is going to be significant differences. I think what Matias is saying around how the market's going to view that in the U.S. versus Europe is spot on. And look, I would just say, just kind of given an overall message, given just finished a 5-city road trip, and I was asked daily about the current administration. What I would say is, your LPA doesn't have an out clause that if you don't like the existing administration, that you don't have to deliver oversized returns. And so stay focused on your mission and stay focused on your portfolio company, and we'll all be okay.
I think that was such a beautiful closing remark. Thank you for taking us out on that, David. Felix, Matias, David, thank you so much. Everyone who tuned in today, I want to thank you as well. Without you guys tuning in, we could not continue building such a beautiful community here in Europe. Thank you so much to all of you.